Chapter 5-2, Accounting for Merchandising Operations. Let's look at Maple Merchandising. The company reports unadjusted first-year sales of $200,000 and a cost of goods sold of $120,000. Part A asks us to compute the gross profit. This is straightforward, sales minus cost of goods sold. What do you get? Yes, $80,000 unadjusted gross profit. Now, Part B is where adjustments come in. Maple expects 6% of sales and cost to be returned. So we need to record two adjusting entries. First, for the sales side, the expected refunds. Second, for the cost side, the expected returns of inventory. After those, we'll recompute the adjusted gross profit. Part C checks your understanding of classification. Think carefully. Is sales refund payable an asset, liability, or equity? And what about inventory returns estimated? Finally, Part D moves us into the conceptual side. 3 quick questions. Why must these expected returns be recorded at year-end instead of waiting until next year? Which accounting principles are at play here? And how could inaccurate estimates mislead investors or decision-makers? Take a minute to think, then we'll walk through the journal entries, adjusted profit, and the conceptual answers. Now let's work through the adjustments for expected returns. First, on the sales side. 6% of sales, that's $200,000 times 6%, gives us $12,000. We record this by debiting sales returns and allowances and crediting sales refund payable. Notice that sales refund payable represents a liability, because the company may need to refund customers in the future. Next, on the cost side. 6% of cost of goods sold, that's $120,000 times 6%, gives us $7,200. We record this by debiting inventory returns estimated and crediting cost of goods sold. Here, inventory returns estimated is treated as an asset, because the company expects to get some inventory back. Finally, let's recompute the gross profit after these adjustments. That gives us a new gross profit of $75,200. So in summary, expected sales refunds create a liability, and expected inventory returns create an asset. Now let's step back and think conceptually. First, why do we record expected returns at year-end, instead of waiting? It's because revenues and expenses must be matched in the same period. If we ignore expected returns, we risk overstating this year's sales and profit. Second, which principles are guiding this treatment? We apply the revenue recognition principle, reporting revenues net of expected returns. The matching principle, matching costs with the related revenues. And the conservatism principle, recognizing potential losses promptly. Finally, how can inaccurate estimates mislead decision makers? If the estimate is too low, profits are overstated and performance looks inflated. If the estimate is too high, profits are understated and the company looks weaker than it is. Either way, both situations reduce the credibility of financial reports, which can directly affect investor trust and management's reputation. So, these adjustments aren't just bookkeeping, they're about presenting a fair and reliable picture of the company. That's it for Chapter 5-2. Great work, see you in the next session.